the things I felt I learned about myself. I think there's a lot of questions you can ask in your life. How, what, where, when, and I think always why questions end up being the most meaningful and honestly might be the only things you remember. Like the only thing I will remember in an Alzheimer's ward someday is like, why did I do this? And why was it impactful? And why did I care? And I think at the beginning, you're trying to prove something to people, you're trying to prove something to your family, you're trying to prove something to your investors, you're trying to prove something to an industry. And the truth is, like, at the end of the day, as painful as it sounds, like, unless you're born a twin, you come into this world alone and you go out of this world alone.
Startup CPGers, you are about to hear something truly special. This podcast is a retrospective on the rise and eventual sale of Aura Bora sparkling water. And as usual, Paul Vogue just deals it straight. He talks about what went well, his lessons for founders, what the process of a sale is actually like, and more than anything, I just really loved his reflections about the life of an entrepreneur in CPG and what it means to him looking back on this journey. I think this should be played for everyone far and wide. It's an instant classic. I hope you love it as much as I do. Enjoy. Welcome, everybody, back to the Startup CPG podcast. I am really honored to have Paul Vogue back with us today. And one of the reasons that I'm super excited to have you here, Paul, is because I think you would probably be one of the top 5 guests that we've ever had on the show in terms of, people just walking up to me like at trade shows being like, hey, you know what episode really changed how I think about my business or just, my life or my brand? And they'll talk about one of the ones that we've done with you. So I'm really excited to have you back for another episode full of incredible learning. So just thank you for always being so thoughtful and open and, just candid and having just, I think for me, it's just like the vision that you have about like you learn things that I would never know how to learn. I think because you've been through so many stages of business, like you just see it very clearly. So thank you. I hope that's not overdoing it.
That's very kind. Yeah, I'm thrilled to hear that. You've had a lot of guests, and I'm glad that it's been helpful even to just a handful of people. It makes it worth it for sure.
Definitely more than a handful. So like we got a big audience here and you helped us grow that. So thank you. First of all, congratulations on the sale for Aura Bora. We just are really excited anytime we see an outcome from a brand that we root for so hard in the community. Do you mind first just kind of telling people as much of the details of the sale as you can, and whatever you can reveal?
Sure. Maybe I'll just do quickly by way of background. I guess a little more than 6 years ago, I started a sparkling water company. The idea was most sparkling waters, LaCroix, Waterloo, Perrier, San Pellegrino, have very similar products. And if I blindfolded you, you probably couldn't tell the difference. It's funny, this is now feels like ancient history. It felt like no one was doing interesting flavors at the time. Lime, lemon, grapefruit was kind of the standard issue for everybody. So that was the initial premise. Hey, can we make a sparkling water that can be elevated in terms of flavor, in terms of ingredient profile, in terms of brand, but also something that could be a daily driver where unusual relative to other beverages, where the average use is, 0 to 1 can per day. The average sparkling water drinker is drinking more than 1 can a day, which is not that many things you drink more than one per day in general, let alone as an average of a large group of people. Speaking for myself, at the far, upper quartile of this extreme is a bad day for me is 6 cans of sparkling water. I'm usually closer to 10 or 12, which maybe you could argue blinded my judgment in a lot of ways. But anyway, that was the initial premise was, hey, can someone, I used to say what Sierra Nevada did to beer, or if you're on the East Coast, what Sam Adams did to beer, we'd love to do to sparkling water. Anyway, that was 6 years ago. In 2019 is when that started. And I think we did like $6,000 of sales in 2019 and $500,000 of sales in 2020 and $3 million of sales in 2021 and $6 million of sales in 2022. We had like a bit of a correction year in 2023. We're into $8 million of sales because we essentially stopped advertising all of our D2C business and just focused on retail. So the retail side grew 2x. And then in 2024, that we ended the year around $12.5 million of sales. I think that's the number. Anyway, that is the last X number of days, months, years of my life. By way of background. So the business sold to a group called Next in Natural at the end of January of this year of 2025. They own a number of CPG businesses, some in beverage like Rowdy Mermaid, some in snack. They have a fiber cracker company and a dairy in the Northeast, and just a number of interesting CPG assets. So that is the very quick background.
Okay, that's very helpful to get us up to speed on what had been going on and kind of where you guys got up to, probably to the point where you were thinking about doing a sale. All right, thank you for all that background. That's super helpful to know what happened in the years prior, a nice summary. And can you just talk about your thinking around selling the business? Also, how did that start coming about? How did you get in touch with them, or they got in touch with you? How did that all happen?
Sure. Worth noting, obviously, it's the podcast called Startup CPG, so this varies a little bit. But for those listening to this that are in the beverage industry, or maybe aspiring to be in the beverage industry, specifically ready to drink, it's, I'd say, famously a very cash-intensive business. And the reasons for that is just math of the gross margin you can possibly hit manufacturing this product is quite low. You want to look up large publicly traded beverage companies, you'll find that that's generally the case. And low in CPG is, hey, at scale, if you are selling hundreds of millions of cans or bottles of your beverage company and you get to 40 points of gross margin after freight and after trade. So this is in the gross margin line of the income statement, not net income or EBITDA. I mean, you are running one of the best beverage companies, period. That said, I yesterday was speaking to someone that's in skincare, and their very first production run was mid 80s gross margin. So if the first production run on the first bottle of sunscreen can be mid 80s and the 200 millionth can of beverage is at 40, you can see naturally why it takes so many dollars to scale this up. Not to mention there's just a natural distribution advantage to the Coke, Pepsi, Dr. Pepper, Keurig. Just they dominate the shelves, the fridges, etc. So as a result, we had raised a lot of money. The question was, hey, what got us thinking about a sale? It's worth noting it was us, even though, yes, I started this business. I started this business with my wife, Maddie. Very quickly, I'm not the only person running this business in terms of the board of directors. We had done in 6 years, 6 rounds of capital. We had 137 people on our cap table, which is not by design. That's just a matter of, I didn't know anybody who invested in a beverage company before starting this one. So I just took as many conversations as possible and thankfully met some great investors. And a couple of our investors in particular, our larger investors that sat on our board, felt like, hey, we need to raise a Series B. This is traditionally when a beverage company would raise a Series B. Just to get specific, again, this is a little bit industry specific. In beverage world, from call it 2015 to 2021, and I'll get into some of those earlier years in a second here, what you might consider like a traditional Series B, I'm putting this in quotes, beverage company was one that was selling both single serves and multi-packs, doing at least $10 million of sales, at least across natural, conventional, and usually one other channel. They probably had, one core product line and introduced new SKUs as well. They had very close relationships with big national retailers. And to my point earlier, hopefully fully loaded gross margin was at least 35, if not closer to 40. So we had all of these metrics that, had taken, I guess at that point, 5 years to get to, which was well on our roadmap. Hey, by year 5, we want to be able to do all these things. The difference was what was historically those Series B metrics I just named. A lot of those were still true, but had just gotten larger. So, what used to be, hey, we want to see 10 million in sales. The year prior, I thought, oh man, it might become 15. It's kind of become more like 25 or 30. What became, hey, we want to see you, growing at this scale, even if you're burning a few $1,000,000 a year, which most beverage companies do, became, hey, we're only interested if you are burning far less than that amount relative to your sales. So a lot of brands, us included, are in this tough spot where they got built and started under, I'd say, kind of an old playbook, and everything fundamentally changed in the consumer packaged goods world, beverage included, but CPG in general, in the spring of, what year is that? 2022. The spring of 2022 ended I would say, from 2009 to 2022 reign where CPG was a compelling asset class for venture capital investors. We can get into that a million different ways. The reason I'm bringing it up right now is if you are our board of directors, myself included, we had to make a really tough call of, hey, if we are not big enough to raise a Series B, and we also are not big enough to make this a profitable company tomorrow, we need to find someone who has assets such that they can spread out a lot of the costs, and to them, this can be a compelling asset.
That is very interesting to hear. This is why you are Professor Paul. There's just a lot of stuff in there that I would never know. That's so interesting. Well, it sounds like a just really good planning, probably on your guys' part to just think ahead that much and know when was the time to start. Because you can't just decide to sell and sell, right? There's just a lot that'll go into that process. You just mentioned how many people you had to source and talk to, right? That's a lot of work too. And I know on a previous podcast, you told me the whole time you were running this business, you were spending 50% of your time fundraising. So I
Yeah,
guess
at least. And by the way, if you're listening to this thinking about beverage, that's like a normal number, not normal in other categories. I don't know anyone that runs a beverage company that has not spent 50% of their time fundraising.
all right. So not to scare everyone off too much. It's also very fun and we love it. Um, but yeah, it does take a lot of money, especially when it's going well. Okay, so then I guess you were just doing some kind of cold outreach to people, some warm leads, probably like people referring you to other people who could help you think about selling it, and just like having a lot of those conversations. And they were just one of those companies that someone recommended or you found online, or
Gosh, of those groups we spoke to, I'd say all of the ones that were larger beverage companies that either sold water or sold things in an aluminum can, or it might have made sense for them to have a sparkling water. Those, thankfully, it's a very small industry, is no doubt, that like, hey, most of those folks I had at least some connection to. We'd had a conversation at a trade show or on a phone call, or at the very worst, we were 1 degree away, shared an investor, XYZ. Most of the private equity firms that owned beverage assets, their job is to get to know beverage companies. So same thing, we had like some sort of connection to. I'd say both the holding companies and some of the publicly traded beverage-oriented companies that were on this list, I didn't know all that well. Same thing, publicly traded beverage companies, it's not their job to get to know small potatoes like me. So those, yes, totally relied on introductions. And then some of the holding companies, same thing. Some of these things are like whispers you hear, and some of these things are a lot of holding companies and publicly traded companies are also looking to do investments. So in the world where we were pushing our Series B, which was end of last summer, it's like 10 months ago, a lot of those conversations became, hey, this was like a very common refrain we heard 2 years ago, 3 years ago, 100% we would have done this deal. We're still tempted by it, even though you're a lot lower than our new threshold we'd like to see. We don't, and the threshold is not just random. Some of these things are the nature of, if you're raising larger funds, as a lot of successful investment firms do, it no longer makes sense to write anything less than an X dollar check. It's a little like, if you are at a flea market, or maybe you're at a flea market in a different country where prices are quite low just due to currency differences, there might be a world where you think it's kind of fun to barter down the cost of a necklace. And then only after you realize, I just spent 10 minutes bartering with someone over like a quarter. This just is literally not worth my time. And that's maybe a crass analogy, but that's kind of what these investment firms would say to a small business like Aura Bora of, hey, if I have to decide between writing you a $5 million check or $10 million check for it to make sense for my fund, we don't have enough people to worry about $10 million checks. We need to start deploying 25, 30, $50 million checks. And this has happened throughout this year, in the last 6 months, kind of as predicted, even more so, of the small game of CPG, at least in the beverage world, is just extremely different. So long as saying, hey, we're having these conversations, some of them along the way said, hey, I know a year ago or 2 years ago, we said this is the sort of check we'd like to write, a $10 million check. It no longer is. That said, if you choose to do something else, i.e., rather than selling 20% of the brand for X millions of dollars, if instead you want to do something more interesting where we own a majority stake in the brand, let us know. Which was like, not obviously of, full disclosure, not exactly what we thought. Obviously, when you go out to raise an investment round, that's not what you're thinking. So anyway, some of them got introduced to us along that path of, hey, If this way you're putting together the puzzle doesn't work, there's some other way, let us know.
Okay, so obviously you were successful, which is amazing, but you also had to talk to a lot of people and it's a long process. If there's a brand out there that was kind of in your situation, would you recommend they go about it that same way that you did of, reaching out to kind of concentric circles of people that they had met? Or is there a quicker way for them to turn over all those rocks and, get to people faster or just get through the sale process faster?
My quick advice is like, if there's someone you're looking to talk to because you're looking for them to invest in your company or give you advice or tell you about X or, buy your business, if that's the thing you're looking for, 100% write a sub 4 sentence email that is like to the point, not trying to pull any, tricks, and you will mostly get a response. Most of the responses will be no. But a couple of them sneak through. So I think that's just true in general. I have this silly document on my desktop that I referenced maybe on this podcast before. We had 137 investors. I told more than 3,000 individual people about Aura Bora. So it's not like I had like an amazing batting average. Like 4% of the people I spoke to wrote a check into this business, meaning 2,000, whatever that is, 2,863 did not. I think that unfortunately is just kind of like the name of the game of you need to talk to a lot of people regardless of what you're looking for. So yes, definitely cold outreach is super helpful. Those who feel they are above cold outreach, I would say will always be above cold outreach. And as a result, they will never have any of these like synchronicity moments happening in their life because they're not willing to do it. Whereas I think the vast majority of people, if I got an email this morning that was sub 5 sentences, that was super respectful, I'm immediately like, oh, I'm interested in this person's success. I want them to succeed. And it's amazing the like mental trick of if you ask for help, people are interested in helping. At least in this industry, that's been my experience of it. And I think my favorite adage from maybe the 6 years of running Aura Bora was, if you're looking for money, ask for advice. If you're looking for advice, ask for money. And as I just mentioned to you, 96% of people did not invest in Aura Bora. So I got amazing advice. Each one of those 2,000 conversations was like super helpful in terms of running the business. And so many people asked for advice actually ended up becoming friends of the brand and investors in the brand. So, anyway, long way of saying, yes, certainly reach out.
Okay, that is amazing. That is quotable Paul Vogue. That's getting framed and put on my wall. That whole 2 minutes, I love it. So let me ask you, just out of curiosity, what was the reaction you were getting from some of the big CPG companies, for example, that you were trying to talk to? Because obviously you found an amazing buyer, but what were some of the reasons you were hearing no from people that you would have loved to be able to find as a destination for the brand?
Kind of what I was saying earlier of, I and apologies, I'm just going to give a quick background on what I think fundamentally changed, because I think it changes the whole ecosystem. And just to give an example of this that makes, a lot of sense. You go to the gas pump, it's 10% higher today than it was yesterday. That might just feel like one, business owner rubbing his hands together because he wants to get more money from you from gas. The truth is there's like 11 reasons why that gas pump got higher. And we as consumers are often not familiar with all of the impacts that are on the supply chain before us. So same premise here, except the supply chain in quotes is the capital supply chain. So just backing up, we'll go to the largest entities for us: Coke, Pepsi, Nestle, Dr. Pepper, Keurig. Those are the 4 largest beverage companies. They're all publicly traded. All of them operate with 20 to 25 points of EBITDA margins. And generally they're vertically integrated. They own manufacturing facilities. They distribute their own product. They have employees in stores for everyone I just named in 100 countries around the world. I think for Coke, literally every country. I think 2 months ago, something came out that Coca-Cola is the most well-known English word besides hi, which is just an insane feat. But anyway, I'll say those companies have to continue to sell innovation. Just the way the New York Stock Exchange works is we need to continue to grow. We can only grow so much with the products we sell, such that we need to sell new products. Because they're such large companies, they're not very good, as has been mentioned in this podcast probably 100 times, they're not very good at coming out, commercializing, and scaling new products. They're better at integrating existing products, or so they thought. And from 2009 to 2022, the spring, April specifically, these companies all believed this almost ruse of if we buy a beverage company, we can integrate it into our distribution chain. We can integrate it into our supply chain. And I'm making some numbers up. What was a $30 million revenue beverage business losing $5 million will instantly become a $100 million beverage business making $25 million. That was the goal. And there are a couple of examples where one of those four big conglomerates pulled that off, but there are far more counterexamples than examples of successful integrations with distribution, successful integrations with supply chain, successful integrations with team, successful integrations with marketing. If you watch the Super Bowl, you know, Coke does a Super Bowl commercial every single quarter. When do they start mentioning smart water? When should we mention vitamin water? How should we talk about honest tea, if at all? Like all of these decisions end up being big corporate decisions. And keep in mind, this is usually a brand that started in some guy's kitchen and then sold it, in my case, out of his 2019 Subaru Outback. So anyway, I say all that to say, when those conglomerates realized, hey, we've been overpaying. We overpaid for vitamin water. We overpaid for buy. We overpaid for almost everything we've ever bought. And they were buying these things off of sometimes 7, 8, 9 times revenue, because the idea was, yeah, but they're growing so much faster than the rest of our portfolio. Let's give them a very high multiple on revenue, knowing that next year when we triple sales and reduce costs by 50%, it'll be like we bought it for 1 times revenue. Except that just never worked out. And somehow that ruse continued 2009, 10, 11, 12, 13, until somewhere in 2020, you know, post-COVID, they realized, hey, these things are not worth 9 times revenue, which, by the way, we should have known because our own publicly traded company is not worth 9 times revenue. It's very large and very complex. And all of a sudden, you're seeing these deals come way back to reality. Just to name a couple, you know, Spindrift got bought for about 2 times sales. Poppi got bought for about 3 times sales. They had a stronger gross margin, and Pepsi is like notoriously the biggest overpayer of those 4. So if very large beverage companies, speaking about Poppi and Spindrift, they're doing not a little, you know, $10 million of sales. I think Poppi was doing $400 million of sales. Spindrift was doing $350 million of sales. These are large companies. They are sold national, conventional, drug, mass, club, international, and they are worth 2 or 3 times revenue. You can imagine how that scales its way down. If you're running a beverage company right now, hey, if the best of the best and it's spitting off cash flow every month is worth 2 times sales, what is your company worth? The way that triggers down the cash supply chain, if the big conglomerates say that, next thing you know, the investors that back these brands at Series A and Series B realize we're only going to get an outsized outcome if we hold on to not to $30 million of sales. Keep in mind, Honest Tea and Zico coconut water, those got bought by Coke at like $30 million of sales, which is insane to think about now. Sir Kensington's got bought by Unilever, I think, at about $20 million of sales. So there was just a time where better for you was such a fear of missing out factor that big conglomerates across CPG jumped in. They now realize we want these companies to be more mature. 100 million is now the minimum you can expect for any sort of acquisition. And 100 million means we'll read your pitch deck. It doesn't actually mean we'll buy you. We just want to know the name of your company. As a result, these investors realize we need to wait longer to make less money. That is like not a good equation. They need to, rather than us making 10 times our money in 3 years, if we're lucky, we'll 3 times our money in 10 years. And even that might be a stretch with all of the dilution coming, particularly in a cash intensive business like beverage. So that's how it was from conglomerates down to investors. And now the next people in this chain are, of course, the brands. The brands have this problem where in order to scale to that $100+ million of sales, we need to raise a lot of money. And we can only raise a lot of money if we're above X million dollars of sales, which, surprise, surprise, is the reason why you're seeing so many celebrity-backed beverage companies. Is how many people do you know that can have access to $25 or $30 million without any real traction? The only thing you could say is they don't have traction in the beverage world, but they have this huge advantage in marketing, and they're generally wealthier people from wealthier agencies. And as a result, you see way more celebrity-backed beverage brands than you do other sorts of things. So anyway, that is the way it trickles down the supply chain. The reason I give all that by way of background is I think your question was,
It's basically just, yeah, okay, so what, I mean, you kind of answered it, I think, is what were the big CPGs saying, like for,
Yes. Okay.
and
Sorry.
basically, yeah,
The big CPGs are saying, hey, this used to work. This used to make sense. There were times, and there were still a few large CPG businesses, a couple of which were publicly traded. That yes, like took a look, kicked the tires. We took 3 or 4 meetings, and they said, "Hey, we think there's things about this brand we find compelling. We could have made this work in X year, but right now it doesn't work for us. Like if they're
right.
publicly traded,
Too
hey, we have
small
to
for them to take a bet on at this point, and
yeah, to
just
take a
the
flyer doesn't
numbers
really
and
make
everything.
sense. To have to report it doesn't make sense. Kind of the same premise as the investors, where they're saying, hey, because this is now a big game, we need to write huge checks, not small checks. Same thing for the large CPG companies, whether they're private or public. Hey, we need to take big bets, and 7 small bets is not equal to 1 big bet. It takes the same amount of time, same number of people. There's just less of a chance of a huge outcome.
We'll be right back.
A few years back, when I ran a beverage company, we had to launch using those plastic sleeves to put our designs on the cans. But they looked bad. The sleeves get stretched out, they don't cover the full can, and overall, they just look and feel low quality. Lucky for you, digital can printing technology has come so far over the last few years that now you can launch your beverage brand or new SKUs with a fully printed look, and it's at similar pricing to those plastic sleeves. Our friends at CanWorks, which is the largest US-based digital can printer, are happy to work with our community at very low minimums, even 1 pallet. They've got locations in the East Coast, the West Coast, Texas. Get in touch with them through our contact form. It's at canworksprinting.com/startupcpg. Okay, I got it. So now let's talk a little bit about the actual acquirers. So can you tell me a little bit more about what was that dance like? Who made the first move, and how did those initial discussions go? And, maybe as much as you can talk about the actual negotiation, deal terms, that kind of stuff.
I can't talk much about deal terms, but I can give you generalities. I think it's true, and it's been true of as you can imagine, when I was in this process, I was talking to any connection, acquaintance, or friend that had done anything similar. And I think everyone has a pretty similar experience with this. You uh, if I had to say this in like a pithy way, the offers you'll get, the terms you'll get is like people will always offer the thing that they find least valuable. Um, which makes sense, of course, like I I get it. If I could pay with cans of sparkling water, I would, because that's just like the thing that's easiest for me to procure. So same premise of some of the folks we were talking to, they're running privately owned brands that spit off a lot of cash flow. So to them, cash is uh, ironically, the least valuable thing they have. Equity in that extremely fast growing brand is more valuable. So their offers are cash. For publicly traded companies, say, that are holding a lot of stock, hey, all of a sudden stock is the cheapest thing that they can offer. For some of these folks that are doing a roll up, it's stock in a combined entity, and you'd get, X portion of that combined entity. So it all of these deals ended up looking very different. And I think just like the general rule of thumb is, hey, if you get to know an acquirer, this is probably true of an investor. If you're kind of doing a specific large investment deal, is the side of the table they're on. This is like my favorite political science phrase of you stand where you sit. The idea of it is, if you ask the Secretary of Defense if he needs more troops, he's going to say yes. The reason being, like, you just stand where you sit. The thing that you represent is probably what you think. So if you ask someone, we were speaking to a woman who works at a large publicly traded beverage company, and she, I think her exact comment was, well, we could only do this if we were able to offer you XYZ. And the XYZ was the thing in her mind that she had in surplus, just sitting in the medicine cabinet. Sure, I'll give you 6 Advil for XYZ, because it's no big deal to me. Like, it's something we just can offer you. So that's me speaking in a lot of generalities for obvious reasons. But yeah, I did find that part pretty fascinating. Obviously never sold a beverage business before or sold any CPG business before. And like I said, this was not, just full disclosure, not the deal we were expecting, not the time we were expecting to sell, not the size of business that we were expecting to sell, et cetera. There's so many things that were just kind of a surprise between, 1 year ago today and January. But I definitely learned a lot in that process of, wow, this is how the world works. And then maybe the biggest thing I'll say, and I've referenced this a bunch of implicit ways via the timeline, is so much of this is timing. Almost, this is like an insane thing to say, but just running CPG brands in general, there was a time where I thought, the idea was worth X percent. Let's say the idea is worth 50%, and the execution of that idea is worth 40%, and the timing's worth 10%. I would now say timing is like 80 to 90%, and idea is probably like 0.01%, and execution is whatever the delta is between those two.
And can you just tell me more exactly what you mean about that, about the timing? What are the key parts of the timing that you think are so impactful, just in terms of like the fundraising environment you find yourself in, and when you meet people, or where your brand is at that stage, or what do you mean?
I think people think about timing in terms of meeting consumer needs all the time. For example, if you were a beef jerky company in the last 5 years, like, you are feeling like a genius. Oh my gosh, we sell this high protein, low fat snack, and the world only wants high protein, low fat. Obviously, anyone can start a beef jerky company today. It would be better to have the price flexibility, the vertical integration, and $100 million of sales across 5 channels before the trend starts. When it starts raining, you can run out of your apartment in New York City and start selling umbrellas. Wouldn't you rather have 10 guys selling umbrellas ready and then the rain comes down? Like, some of these things, timing is just luck. And I guess in my example, you could just be a meteorologist. In the same way with protein, you could have been a trendsetter, or, just follow Snack Shot, and Andrea will tell you what's coming next. But I'll say that's the timing we talk about. The truth is, there's so many other timing aspects of, I remember when we started Aura Bora, people used to say all the time, like, oh, another sparkling water company. We don't need more sparkling water, which could be true. The truth is, in the years since, sparkling water has grown net like 60%. So like what felt like a lot of sparkling water in 2019 in the United States, hey, we continue to drink more sparkling water. We continue to have more brands. We continue to just, people are trading soda, et cetera. So it turns out, hey, yes, this was an enduringly fast moving trend, but it was also going to continue to grow. That said, the timing we don't often talk about is what I was just referencing, of a deal can get done between, I'll use a much larger, real cash rich acquisition. You're drinking a Poppy right now. Obviously, Poppy sold for years. That company could have sold. They were of scale, of gross margin, et cetera. The timing happens only when makes sense for both parties. Only when the larger party is like, okay, now this is something we can deliver to our shareholders. Same thing with maybe Celsius and Alani Nu. I think Celsius looked at 30 different beverages over the last 16 quarters that they might buy. They've had a extremely fast growing stock. What's funny, when you have a fast growing stock, you can look at these deals, but you have to realize, the stock we're going to offer for this might double in the next 2 years. Would we pay twice as much 2 years from now or not? And all of us, it's just like becomes a crazy math equation. Anyway, I'm saying all that to say, all of these timing things need to work out. You need to have the right trend at the right time, have the right things set up. You need the category managers to be interested in your category at the time that you have a product ready. And you need investors and macroeconomic cycles to work in your favor. Just to give one more CPG specific example, there was an awful supply chain disruption as a result of COVID. I know 25, 30 entrepreneurs that had amazing traction and overnight gone, unplugged. Oh, you were importing coconuts for your product? Which coconuts? The ones that are worth 9 times as much? That's not really going to work as it works its way up to your supply chain. So all of these things, timing, I'm mentioning because you inherently just have no control over it.
All right. Very interesting. And yeah, I can imagine a lot of that stuff that you could not even anticipate, like the trend toward non-alc, which I think a lot of that does actually come into sparkling water. Like if I have a party at my house, a lot of people aren't drinking and they're really happy to have a flavorful sparkling water, something kind of fun, but hydrating. So
total luck. To your point, I didn't know the word mocktail when we started.
Yeah. All right. So Paul, looking back at all of this stuff, where are some things you probably would have gone in a different direction if you could do it over again, whether it was your, how you did the fundraising all along, or some decisions you made about investments for the business, marketing decisions, or, how you kind of focused on different channels as you were growing the business? Is there anything that you could have done that would have potentially changed how much cash you needed to get to where you needed to go, or you could have just been operating much more efficiently to like even let you scale to a much higher revenue over time with the amount that you were raising?
Good question. I think hindsight is 2020 for sure. So I've effectively out of the beverage world for a few months. Obviously still read things, but not actively calling distributors or transportation people. Long way of saying I've definitely had some time to think. There's so many ways I can answer the question. I'll answer it from a big way of like, hey, do I think sparkling water is a compelling category? No. Like I don't think it's a compelling category to build a business like this in. And that's coming from a guy that's we sold, 30 something million cans of sparkling water. And I just think it's not a great category for a lot of the reasons we already talked about. It is far too discount heavy. There's very little brand loyalty, which the benefit when you're a $0 of revenue brand of lack of brand loyalty is, whoa, there's no brand loyalty. People will buy my stuff. The negative is when you're a $10 million brand, whoa, there's no brand loyalty. People will buy the next guy's new stuff. So I think all of those things combined takes a lot of cash, super gross margin heavy, super discounted. The fact that I'll name one specific thing about sparkling water that I think makes it so not compelling. I could name you 10 sparkling water companies that are each giants. I think sometimes you're just competing against one giant. If you are making a sandwich cream cookie, you are competing against Oreo. That is the one giant you're competing against. If I do that same thing for sparkling water, at the risk of getting too specific, I could name a bunch of independent brands, Spindrift, Waterloo, LaCroix. I can name a bunch of Nestle-owned brands, San Pellegrino, Perrier, Pepsi-owned brands, Bubbly, Coke-owned brands, Topo Chico, Aha. Like, it's just kind of crazy that it's unusual in a category that there are more than 10 brands, each doing more than $200 million of scanned sales. That's very unusual. If Tuna fish, there are 2 brands doing $100 million of sales. Chocolate chip cookies, there are 3 brands doing $100 million of sales. So it's very usual to have like a double digit number of giants. So long way of saying, if I could do anything differently, the honest truth, and I don't mean like no one needs to play a violin for me, but like, yeah, certainly would not have picked this category to build in. Of course, it was a category that's very close to me. Like I said at the beginning of the podcast, I drink like a gallon of this product a day. I don't drink a gallon of anything else. But that's like not really a compelling reason to build a business, because it's something you enjoy. If it's something that you happen to enjoy, that you feel passionate enough about to do every day for 20 years, because that's kind of what it takes to build up one of these businesses, maybe that's enough. But for me, probably not.
That's super interesting. And I think about that a lot because obviously there are a lot of emerging companies in the sparkling water and regular water space. And I think, yeah, I mean, challenged number one by the price point, right? There is a price ceiling, especially if there isn't a really strong functional story about it. And that's always going to haunt you. It's just really hard to get a buyer on board with you being way more expensive than what's out there. And there are, yeah, I mean, you're talking about like the market's very fragmented and there are also a lot of strong regional players. There are strong private label offerings that really keep that price ceiling intact
Yes,
in
I
the
should have
market.
added that too. Hey, there's 10, 15 companies that do $200 million in scanned sales in sparkling water. And then if you're running a grocery store chain of 15 stores and you don't have a private label sparkling water, you are missing out on, I think, Wegmans, just to name one regional example. Wegmans is not a huge grocery store chain. They are just in the mid-Atlantic and Northeast, and their private label sparkling water is the size of Spindrift, only sold in their stores.
All right, pretty interesting. I mean, I hope even if you had known all of that at the beginning, you would have followed this dream of yours because I mean, it did lead to a good outcome for you, and it may not have been the billion-dollar brand outcome that I think a lot of us hope for, especially as we get into that early growth stage. Like, what could go wrong? This is going to be amazing. It's always going to be this amazing, and it'll be everything. But yeah, I mean, I guess I think it's true for you, and I hope that it is true that you worked very hard for a long time and just had probably so many highs and lows, and hopefully the highs were a lot higher than the lows. And that kind of, even looking at this at the very beginning, you would have been like, yes, I do want to do that. And it's going to be worth, it's like, better than the opportunity cost that I have of doing something else. I hope that for you anyways. I hope that's how you look at it.
I know. I don't know how I look at it. I think, one, it depends on the day, and two, it's very kind for you to say yes. no matter what, it is certainly the 6 years I ran Aura Bora is certainly like the only way I know anything about how the world works. Like I was 24 years old when I started this business. I effectively knew nothing relative to how I feel of what I know now, not just about CPG in general, like about life, about the way humans work, about what is good work, what's a meaningful day, what feels like a fulfilling way to spend one's time, what actually makes a difference, what's moral, what's immoral, what's the sort of thing you'd be proud of as an 80-year-old, what's the sort of thing that you'd kind of cringe at. All of those sorts of questions, those were not like yearly things. That was like a weekly normal onslaught of things to think about.
Let me ask you one follow-up on that. What did you learn about yourself that you're really proud of during that time? Because I feel the same way of the times that I've worked really hard and the things that went well. And not everything does always go well, but I mean, just, we're competitive, we're ambitious, we're doing this stuff, and there are probably a lot of things that you were able to accomplish that you didn't know you would be able to do. What are some of those things that you're really proud of that you learned about yourself during that journey?
Gosh, this won't be true for everyone because most people are just smarter than me and will have more experience than me as I did when I started this business. But yeah, I'd never managed anyone. Period. I had 0 employees my whole life, and then at its peak, I had 17. I'd never like managed a team or a profit and loss statement or any sort of enterprise of any scale. Like I used to sell Christmas trees in the winter or t-shirts in college, but like nothing of any sort of meaningful scale. So I definitely had sometimes folks will call and ask like, hey, should I do XYZ? And I'll be like, look, I did XYZ because I had literally nothing to lose. I was like stupid with no good ideas and nothing to lose. For a lot of people, it's a different equation, almost in a negative way, like where they have a family in a high paying job. No one was paying me a lot of money in general. So that said, the things I felt I learned about myself at the beginning, I think there's a lot of questions you can ask in your life: how, what, where, when, and I think always why questions end up being the most meaningful and honestly might be the only things you remember. Like the only thing I will remember in an Alzheimer's ward someday is like, why did I do this? And why was it impactful? And why did I care? And I think at the beginning, the why was like, man, you're trying to prove something or you're trying to prove something to people. You're trying to prove something to your family. You're trying to prove something to your investors. You're trying to prove something to an industry. And the truth is, like, at the end of the day, as painful as it sounds, like, unless you're born a twin, you come into this world alone and you go out of this world alone. So you get 100 years to live. I used to ask folks the first interview question if they work at Aura Bora, but there's so many ways to spend one's time. Why do this? And I think sometimes like long-time CPG people will tilt their head and be like, why are you asking that question? And the truth is, I'm actually just interested. There's so many ways to spend one's time. If you have an abundance mindset about life, why specifically this? And I think my answer, and I didn't know this until a few years in, is of all the ways to spend one's time, I find this like pretty delightful. Like something you made with your hands. Like I just like creating things. And I didn't really know that about myself. Yes, I was a creative person for sure. But I didn't know the fulfillment I would get from creating anything. And of course, a bit of like selfish satisfaction of watching people enjoy it and watching it scale and, getting pictures from airports and grocery stores and sports games where people were enjoying our sparkling waters was meaningful, not because it represented a sale or because it was good in a quarterly report or it proved some teacher in high school that thought I was a miscreant that I could do something impactful. It was more so of just very simple. I created something and it exists. And I think anyone that's listening to this, whether you would call yourself a creative person because you sing a cappella or you're in the play or not, all of us are creative in that we were made to create. I actually think that humans were made to create whatever that thing is that brings you joy. Like that is kind of our core purpose. Between 0 and 100, I think what you look back is what did I enjoy and why did I do it? And I think the answers will be almost always something that you created if you were so fortunate, that gave you some perspective and some gratitude for being on the planet. So as silly as it sounds to have a big macro thought like that, when, at the end of the day, I was selling lavender flavored sparkling water, it is what I think of. We're kind of just made to create. And I don't think I necessarily knew that 6 years ago.
I love it, Paul. I think that was really beautiful. And I hope everybody listening maybe did a little bit of reflecting while you were talking about that, about like, why do I do this? And maybe not all of them are in the same position that you were in, of just having the right conditions and ambition and hustle to actually go out and start something on their own. But maybe even if you're just like, you're a salesperson at one of these companies. But I think, for probably all of us, I think there's just something that we love about the industry. I mean, I always just say CPG is fun. And that's why I do it. Everything about it is fun, but it's sort of like, it's just the arena that I want to be playing in to do all of the things that I like doing. But anyways, I hope everybody takes that as an opportunity just to remind themselves why they do this, and maybe it'll make them think of doing it in a different way, or maybe starting their own company, or maybe they won't because they've also just heard about a lot of speed bumps along the way. So, just one kind of more tactical then question about specifically the fundraising journey,
Sure.
how you raised money, and I know you talked about having done even like a family round, or friends and family round in the early stages, and like you did Shark Tank, and then all of the 6 different rounds or whatever that you did. Um, is there anything that you think you probably would have preferred to do a little bit differently, or that you would just tell brands now, like, yeah, maybe think about doing this way if you want to get to a good outcome more profitably, or more capital efficiently?
I'll say for those brands that are listening to this that don't need to raise outside capital because their gross margins are good and they've found a way to, grow at an acceptable speed relative to that gross margin, or maybe they're able to get a lot of debt, like as a result of that same cash supply chain I referenced earlier, from conglomerates to investment firms to brands. Like, one of the things that's filled that gap is really efficient debt capital at a much lower interest rate than people are probably expecting. So if you're one of those brands that can leverage all of those things, your great gross margin and great debt, and not raise money, of course. That's like my yeah, no offense to our capital providers, that's the best. I had this silly Christmas tree farm that I used to do for 3 weeks every December, and it was awesome that it was 3 weeks long. It was just in December, so I could just max out my credit cards, buy hundreds of Christmas trees, and know that I can pay them off 3 weeks if I worked hard. Like, as silly and simplistic as that is the best version of business, of like, your expenses, you own 100% of it, and you can find a way by hook or by crook to like sell something for more than the cost of goods in it. So if you can pull that off and have a profitable business, absolutely. For those that can't, because the industry they're in or the scale they need to grow, et cetera, et cetera, et cetera, I guess I would generally say, if you are so fortunate to have one particularly adept capital provider that you can closely partner with, that is like certainly the best way. And I'm saying best in quotes because I think it's best in that, you guys are equally aligned. Hopefully you really enjoy working with one another. I know so many examples of folks that raised money from capital partners that they really regretted. And ironically, it actually is easier to get divorced than it is to get rid of a capital provider. So my answer to those fundraising is, hey, it generally is better to have one well-funded firm that's interested in continuing to back you over the course of several years. If, of course, if the brand is working and you're working hard and you're hitting all your goals. If you can't do that, which will be the most people because there's not that many of those firms and they don't do that many of those deals, I would generally say, I definitely spoken to a lot of brands that have a lot of questions about fundraising. I try to just golden rule everything of, if it were me on the other side of the table, like, what is the deal that feels fair to me as an investor? And for so many of these things, as I just referenced, like, yeah, the multiples come down at the top end of the spectrum. The revenue multiples need to come down in your round. And it might mean you own less of this business than you would have had you started it 10 years prior. And that's just true. So my other fundraising advice is like, be reasonable. The odds anyone succeeds in CPG, and I'll be specific when I say succeed. I'm using the word succeed to mean a tangible investment dollar is returned to investors. Forget the entrepreneur. If investors put $1 in at some point and got $1.01 out, and we'll call that a successful CPG business, that is like 1 in 100,000. So just know that, hey, when you're raising money, 99,999 times, that dollar will become less than a dollar, whether it's 0 or 99 cents in the future. And as a result, like, yeah, these things are priced accordingly. It's that's just like the painful truth of it. So I'd say keep that in mind. If you're fundraising, it's so easy people to focus on their business, and they need to be maniacally sure that it's going to work. And of course, that's true. Everyone that jumps into the pool at the Olympics thinks they're getting the gold medal. And I can name Michael Phelps, and I don't know a single other person that was in the pool with him. And that's just like the painful truth of this business.
All right. That's the hard, sober truth of it, but it is the thing that so many of us love to do. So good luck to everybody, despite the long odds. I mean, I hope everybody enjoys the journey as well, because it should be fun, even when it's hard. And a lot of that is what makes it fun. Okay, cool. So Paul, just last question for you here. What's up next, Paul? What are you spending your time on now? How can people kind of still follow along with you, even though you're not actively working on Aura Bora anymore? How people will, I think, just be interested to keep tabs on Paul.
Gosh, that's very kind. If they want to keep tabs on Paul, I'm an easy guy to find on LinkedIn for sure, and other social media sites. What's next in general is I just wanted to take some months and clear my head. So I'm actually about to leave for the John Muir Trail here in a couple weeks, and do a big hike with some friends. Yeah, I made this silly word game just for fun. To my point earlier, I really like creating things. So if you like word games, it's called Outlier. You can find it at outlier.land. I've been consulting for some businesses just to stay busy. So what's next right now is just, hey, I love the consumer world. I'm sure that the next thing, if I'm so fortunate to make, will be something consumers can interact with, either something they pour in a glass, like my former thing, or something they click on a screen, or somewhere in between. But for right now, I'm not really sure. I definitely, in retrospect, to my point earlier, felt like I rushed into sparkling water because I was so excited about it, and I was 24, and I'm trying not to rush into whatever that next thing is. And like, fortunately, I have the benefit of both time and perspective, and can afford to do this. So that's what's next.
I love it. And I have played the game. I can tell everyone it is
great.
fun. Check it out, outlier.land. It's cool. You basically go in and you're just trying to pick the thing that doesn't fit with the others. And it's fun in that way that, like, Angry Birds is fun, and like, Wordle and all that stuff. So everybody check it out, outlier.land. Paul, thank you. This is another instant classic. I'm really excited for everybody to get to hear this, and I will look forward to seeing what the next adventure is.
Thank you, sir. Good to see you.
Good to see you. All right, everybody. Thank you so much for listening to our podcast. If you loved it, I would so appreciate it if you could leave us a review. You could do it right now. If you're an Apple Podcasts, you can scroll to the bottom of our Startup CPG podcast page and click on Write a Review. Leave your company name in there. I will try to read it out. If you're in Spotify, you can click on About and then the star rating icon. If you are a service provider that would like to appear on the Startup CPG podcast, you can email us at partnerships@startupcpg.com. Lastly, if you found yourself grooving along to the music, it is my band. You can visit our website and listen to more. It is superfantastics.com. Thank you, everybody. See you next time.